Good morning, students. Today I want to look at depreciation. Let me remind you that you have a test coming up on Friday, and I've already given you a study guide. It's also on Wolf Den. So let's take a look at Wolf Den and what's available there. Okay, if you go to your test 2 material, okay, right here, test 2. A lot of information. We have all the ratio information, accounting review. We have DuPont. I've given you Apple answers, which you went over yesterday in class. DuPont problem, a prior problem on interest and dividends that I did, I believe, the first day I was out. Ratios, just a handout, and I'll give you that on the test. Bartlett financials, which we used as an example. Here's where we are today. You need to pull up depreciation problems. Okay, so depreciation problems, we want to look at that. Pull that up. Here are your Apple financials, which we've looked at. Answers to the 10 questions. That will be one problem on your test. Then you had some chapter 2 material, which goes back over a month. This was picked up either right before I left or right at the same time when I had my accident. So a portion of that will be on the test. Benchmarks were just some, you need to know what it is, but these were numbers for comparison. There's your 10 questions if you want another handout. You also need to pull up your depreciation PowerPoints. This is where we are today. I have no idea why they don't load in any certain order, but you want depreciation for today, both the problems and the PowerPoints. Chapter 2 in class homework tax problems. I've given you some information on that. We went over that, tax liability, interest dividend problems, homework on capital gains, possibly a question on the test problem. Then we had these other ratios. Now these will be in multiple choice form, so you need to know how to work those with answers provided. More on Bartlett. Here's your study guide with the bonus on it, and also the video links where you will find all the videos that you need for this test. Okay, now let's get started. Let's go back up. I want you to get that depreciation PowerPoints, and I want you to pull up the problems. Okay, that's the PowerPoints. Come on up to the problems. Again, I don't know why they don't load in a certain order. Okay, let's take a look at the problems, which I'm going to work down at the bottom. Okay, the examples are also on the video. However, down at the bottom of this problem, you have a homework assignment. This homework problem, under both methods I look at, will be due on Friday when you take your test. And my husband will be there to give you the test, so be good if you turn in this whole page, but particularly the last 2 problems. Okay, so let's get this out, get it ready to work. I'm going to go through the examples with you as I go through the PowerPoints. Okay, looking at these PowerPoints, let me put it on slideshow, and I'm going to go through and talk to you a little bit about what depreciation is. And this has to do with a lot that we learned in Accounting 210. But we're looking at plant assets. These are assets that are tangible. You can feel them. You use them when you're producing your product or selling your product. They should benefit you many years into the future, well past a year. We call these assets property, plant, and equipment. Now here's a good little example. You've probably seen this before. You buy a building, brand new. You can think of Brokaw over there. You start using it, okay? It starts to wear out, okay? Until it virtually looks like Brokaw and you're ready to tear it down or sell it. Okay, so what we're wanting to look at in depreciation, we have a decline there in the asset value, okay? Now, some people will say depreciation's a write-off. Don't write down write-off of the cost, okay? Don't put that down. There is a formal definition for depreciation. Let's go through here. We'll come back to this. Okay, this is the formal definition, and you will see this on the test, so make sure you answer the question according to the definition here. Depreciation is the process of taking the cost, allocating it, of that asset to expense in the accounting periods benefited. Okay? It's taking the cost, and in my words, spreading it out over the useful life of the asset. Okay? So you have an asset on your balance sheet. That's what this is over here, your cost. You have an asset on your balance sheet, and what you're doing is you're taking that cost and you're spreading it out over a period of years and putting it on your income statement as an expense called depreciation expense. Okay? Now, three things. You need to know the definition. You need to know this slide. When you have depreciation, you need to know the cost of the asset. Now, the cost may include amounts to put it into place. If you buy a machine, you have to install it, you would include the cost. Okay? You need to know the salvage value of that asset, what you think you can get for it at the end of what we call the useful life. And the useful life is how long do you think you can use that asset. Now, just because we think we can use something 7 years, like a car, that's normally the depreciation time frame on a car, doesn't always mean that we can. Okay? Something may happen, that car may break down and we have to junk it in 5 years. Okay? So we readjust our depreciation. Once you've used it 7 years, if you continue to use it, you just can't continue to depreciate it. For instance, Brokaw has been around since the 60s. I'm sure it's fully depreciated. Okay, they make all profit from the building. They have to show no expenses on it. So it's fully depreciated. It extended its useful life, which for buildings probably is 20 to 25 years. Okay, and it's been around, 50 at least. Okay, 56. Okay. Now, let me just flip back to a couple slides that we missed. Okay, and you don't have to memorize all this, but this just kind of gives you an example of what I'm talking about with including the useful life and the value of that asset in depreciation. This is an example. When you acquire it, you can include the purchase price as well as what you have to pay to get it installed. They're installing a washing machine here. It could be a copier, but you cannot include any finance charges or discounts on that machine. Okay, just some examples. For land, know this. Land is not depreciable. Okay, we always assume that land is going up in value. You can include all of this in the cost of land, but you never depreciate it. So just know that land is not depreciable. Now, when you build on that land, that building is depreciable. You can spread out that cost of that building, like Brokaw, over a period of years. So you would include the cost. You would include what we call title fees that you have to pay to make sure that you own the building and no one else does. You would have attorney fees that you pay, taxes, and what we call brokerage fees. That one's a vague term. Not financing charges. These are just additional fees that are normally included in the purchase price, okay? Another one, machinery, purchase price. You include taxes, transportation, like if your dealership is transporting cars. You've seen these cars on these big transport trucks. The cost that they have to pay to that transport trucking company to move those cars to their dealership would be included. Any insurance on those cars and installing or getting them ready. Again, if this is a piece of machinery, anything to get it ready. And I've given you the definition. Let's go on down to our first example. This slide, there are many methods of depreciation. We're going to look at two. We will look at straight line depreciation. The others I looked at in Accounting 210, and then we'll look at one that's used for tax purposes called Modified Accelerated Cost Recovery System. Okay, now let's go to our first problem. So go to your handout because this problem's illustrated, and let's work through this. Okay, in the first problem, we have an asset that cost us $10,000. We know the salvage value, which we think we can resell it for at the end of its useful life, is $1,000. And we think this asset will last us, what did we say here, 5 years. So we want to calculate what we call straight line depreciation. This one is normally used for financial accounting. So let's take the 10,000. We want to take the cost. This is under straight line. We want to subtract the salvage value, and we want to divide that by the useful life. Okay, and this is going to give you straight line for 1 year. Okay, however, we will show this on our income statement for 5 years, the length of useful life. So the cost of this is $10,000 minus our salvage, which is $1,000, divided by 5 years. Okay, running that through your calculator, what you come up with is $1,800 per year is your depreciation amount. And the journal entry to make that is to take your depreciation expense as a debit, and you would credit what we call a contra account called accumulated depreciation. Okay, and this account goes on the balance sheet. The depreciation expense goes on your income statement, and this account actually offsets the cost of the asset. Okay, it also offsets the cost of the asset. Now here's the calculations on the screen. You can go back and look. There's the journal entry, which you saw me work it. Now this is what the balance sheet looks like. You would take your machinery, you would deduct your accumulated depreciation. Now every year you're going to accumulate $1,800 in that account until the end of the 5 years. What we call the book value will only be $1,000. So after 5 years, that book value would be $1,000, and you would have $9,000 in the accumulated depreciation account. And this just shows you a little summary of how that goes. You don't have to get too hung up on this page, okay? Now, let's take another example. So here's second example. Come down here. Now in this one, we have an asset that cost $42,300. We have a useful life of 10 years. Don't pay any attention to this units. This is for another type of depreciation called units of production. We have a salvage value of $6,000. So let's calculate straight line depreciation. Again, our cost is going to be $42,300 minus the salvage value of $6,000 divided by the useful life of 10 years. And when you run that through your calculator, you would come up with $3,630 per year. Okay, the journal entry would be this journal entry, and you would plug in the numbers here accordingly. Okay, so just have an idea of how to do straight line. It's the easiest one that you'll learn. Okay, here's your answer if you want to go back to your PowerPoints. Now, this is just another definition. I've already told you, you're taking the cost of the asset and you're spreading it out over the useful life. However, for tax purposes, they use a method called Modified Accelerated Cost Recovery System. And the idea or benefit here is to give taxpayers a higher depreciation in the early years and a lower depreciation in later years. Okay, so under this method, this is what you would use for tax purposes. However, for financial reporting in your financial statements, you would choose one of the other three, and I just showed you straight line. It's the most popular method because it's easiest. Okay, let's take a look at your first problem here, Baker Corporation. So come back down and let's take a look at Baker. We'll also refer to the slides here. Now, Baker Corporation is getting a copier, and the copier is going to cost them $38,000. They're going to have to pay for installation of $2,000. When it's retired, Baker expects to scrap the metal for $1,000. Now notice there's no useful life here. They don't give you one under just in the problem portion under this method. But let's answer the questions. First of all, what's the cost or amount that you would depreciate? Well, it's going to be the cost plus installation. So the cost of installing it, and I've already mentioned that. So you have your $38,000 cost, and it costs you $2,000 over here to the left to install it. So the amount that we want to depreciate is going to be $40,000. Okay. Now they want to know what the recovery period is. This is comparable to the useful life, and I've given you the page number from the book, but I've changed that and also given you a slide to look at. So let's look at slide 4-20. Okay, so come back up here. Let's go down. We were on 17. Let's go down to 420. Now 420, this is a table out of the book, and I'd have to give you this on the test or tell you in order for you to know. But the tax system, tax code, breaks down property into different number of years. They make it simpler. They categorize it. So 3-year property would be research equipment, certain special tools. I'm not aware of what that would be. 5-year, look at that though, computers, printers, copiers, duplicating equipment, cars, light-duty trucks, technology equipment, and similar assets. So you see our printer falls into a 5-year recovery or useful life. Notice cars do too. However, financial reporting, you could get by with 7 years on a car. Notice for 7 years you have office furniture, fixtures, manufacturing equipment, railroad, tracks, single-purpose agricultural. There's a lot that would fall in there. And then 10 years is going to be your big equipment used in petroleum, refinery, tobacco products, certain food. So we know that 5 years is our recovery period here. Okay, so for 5 years, and I would have to give you that table because I don't expect you to memorize that. Okay, so how much for each year are you going to depreciate it? Well, on my revised problem and in the PowerPoints, I tell you to look at 4-21. So let's come down here to 421 and look at what we have. The tax code gives us a breakdown. For 3-year equipment, notice we're depreciating it actually 4 years. We take the biggest amount of depreciation, 45%, in year 2. Our equipment, our copier, will fall under 5-year. Notice we get to do 6 years. Okay, we start out with a modest amount, then we go to our largest amount in the 2nd year, and then it starts declining from there until the 6th year you get to take just a small portion. And that's the case with all the way across. So they have to give you the rates, and I would have to give you the rates. So let's take and do a table here, starting with the 5-year property. Now, coming back to our paper. Okay, in year 1, we would have to take the $40,000. You cannot use